All right, chapter 14, our last chapter. It's a pretty long chapter, and some of this stuff we've already gone through. So the stuff we've already gone through, I'm just going to kind of skip over. That would be the deductible interest that we've already talked about. We talked about the deductibility of real estate property taxes and home mortgage interest deduction, all that stuff. So I'm just going to kind of skip over that and hit the high spots. Try to keep this as basic as possible, because there's a lot of information here that to digest. All right, so first thing we have to do in determining how we treat certain expenses, and this is true for all that stuff that we've already talked about, home interest deduction, property taxes and stuff like that. But before you even get to the deductibility of all that, you have to figure out whether or not the property you own, number one, is a dwelling unit, and number two, whether that dwelling unit is a principal residence or just a residence or maybe even rental property. So what is a dwelling unit? Well, it includes a home, but it includes other types of dwellings as well. A condominium or townhome, boat that you can live on is considered a dwelling unit. What about a mobile home? I think that's a dwelling unit because you live in it, right? It's kind of hard to think what wouldn't qualify as a dwelling unit. Roy doesn't get into this. Certainly if you have an office and you live there, I'm not sure that would qualify as a dwelling unit. Not only that, but when you have an office that's subject to a lease, which is almost all the time, one of the things they prohibit is that you use it as a principal residence. And if you have a dwelling unit, this dwelling unit may be used for different reasons. You could use this solely for personal use. You could include both personal use and some rental use. In this day and time with all these what is it called? Airbnb, I guess is how you pronounce that. And maybe there's others. I'm sure there's others because I get the emails advertising them. Other types of services where, instead of traveling and staying in a hotel, you can actually stay in somebody's residence. So, if you're the owner of this residence and you stay there part of the time, but you also rent out part of the time, it's going to be a mixed use property. And then you might have a property that's strictly for rental use. And if you look at Exhibit 14-1, it gives you an idea of what coverages or what things you can deduct depending on the property type. And so whether a dwelling unit, remember you've got to figure out whether a property is a dwelling unit first. If it is, then you have to figure out whether it's a residence or a non-residence. And determining whether a dwelling unit is a residence or non-residence for tax purposes, it depends on how the unit's used. And so the dwelling unit is considered a residence if the personal use days is more than the greater of 14 days or 10% of the number of rental days during the year. That's not very much. So, you know, what's this going to apply to, this, especially the second part? Well, if you rent your dwelling unit for 140 days or less, at 140 days, the 10% of the number of rental days and the 14 days are exactly the same, right? So as long as the owner, and we'll look at some other things, it's not just exclusive to the owner, it's family and some other things we'll look at here in a second. And the rent days are 140 or less, then as long as the owner is using it for personal use for 14 days, no problem. It's considered a residence. Now, if they rent this dwelling unit out for more than 140 days, then the personal use has to be greater than 14 days. So anyway, not to dwell on that too much, but that's kind of how that works. If they don't live or use the dwelling unit for the requisite number of days required, then it's going to be considered a non-residence for tax purposes. And again, look at Exhibit 14-1 as to why that makes a difference. Now, personal use days includes the days that the owner or other taxpayer, owner, or other owner stays in the home. So if you have like a co-ownership, it could include the taxpayer, but it might include some other owner of the home or dwelling. Relative of the owner, even if the relative pays fair market value. Days a non-homeowner stays in the home under a vacation home exchange or swap. Days a taxpayer rents out property for less than fair market value. So any of those would qualify as a personal use day for the taxpayer. Rental days include days when the taxpayer rents the property at fair market value. It also includes the days where the property is under repairs or maintenance in order to get it into rental use. Now, the days the home is available for rent but not rented out are not either personal or rental days. Now, once you've determined that you have a dwelling unit owned by the taxpayer and that the dwelling unit is a residence, then you have to determine whether or not the residence is the taxpayer's principal residence or just a residence, not the principal residence. Now, they give some factors that they include, they meaning the IRS, in determining whether a residence is a principal residence. Some of those are the amount of time the taxpayer spends at each residence during the year. Usually the one where they spend most of the time is going to be the principal residence for that year. The proximity of each residence to the taxpayer's place of employment. The one that's closer is probably going to be the principal residence. Principal place of abode, where the taxpayer's immediate family stays. And the taxpayer's mailing address for bills and correspondence. And note that this principal residence can change from year to year. And so, for a given year, for tax purposes, a dwelling unit may be either a principal residence, a residence but not principal, and or a non-residence, rental property. And so here is your Exhibit 14-1, which shows the effects, tax effects, of each classification. So this inquiry is not without some reasoning. There's a reason why you have to go through this inquiry of whether or not this thing is a dwelling unit, and if it's a dwelling unit, whether or not it's a residence, and then if it's a residence, whether or not it's a principal residence or a non-principal residence or a non-residence. Don't really want to get into the non-tax consequences of home ownership. Certainly, we've seen some of the tax consequences, that being the interest expense deductible, real property taxes on home being deductible. One thing we haven't talked too much about is rental and business use possibilities. We'll talk about those briefly. And the one I want to concentrate most on is this gain on the sale of a home. Remember, your principal residence, which is the main one we'll be talking about, is a capital asset. And so it has to be considered when you sell this capital asset for more than its basis, because that's a capital gain. And we'll talk about what happens when you sell a principal residence for less than its basis as well. And so the sale of a personal residence is a capital gain or loss, but because it's a personal use property if you sell it for less than its basis. If you sell your principal residence for less than its basis, then you don't recognize a loss. But you would recognize a gain. However, there's exclusions on that as well. And so part or all of the gain that you realize from the sale of a residence may be excluded if it meets certain requirements. Now, the maximum exclusion is a gain of $500,000 if you are married filing jointly. If you are any other type of taxpayer, the exclusion is $250,000 gain on the sale of a residence. Any gain in excess of the exclusion is considered a capital gain and taxed as a long-term capital gain. So at least it's subject to a preferential rate. It's not an ordinary gain that we're talking about. Now, in order to qualify for this exclusion, the taxpayer has to meet the ownership test and the use test prior to or at the time of the sale. The ownership test just says that the taxpayer must have owned the property for a total of 2 or more years during the 5-year period ending on the date of sale. If the married taxpayer, well, if you have a married taxpayer, either spouse can satisfy this 2-year requirement. And so this requirement's meant to prevent a taxpayer from buying a home, fixing it up, and soon thereafter selling it, allowing them to exclude the gain. So if you watch any shows on TV, DIY Network or what's the other one? Home and Garden TV, those shows about buying property and flipping them, you're not going to be able to, those people are not going to be able to utilize this exclusion because usually they don't they don't own it long enough, and even if they meet the ownership test, they still have to meet the other test, which usually is the biggest problem. And so the use test is the one where they're, even if they meet the ownership test, they're not going to be able to meet the use test because the taxpayer must have used the property as the taxpayer's principal residence for a total of 2 or more years during the 5-year period ending on the date of sale. If married, both spouses must satisfy this requirement. Okay? This requirement's meant to ensure that taxpayers are selling homes that they actually lived in instead of investment property. So why do you think it says 2 or more years during the 5-year period ending on the date of sale? Well, you may get into a situation where you meet the ownership test, the 2-year ownership test rule, and you live in it for 2 or more of years of the 5-year period prior to the date of sale or ending on the date of sale. But let's say you buy a house in, 2010, and you sell it in, let's see, 10, 11, 12. You sell it, let's say you buy it January 1, 2010, make it nice and simple. And so 10, 11, 12, 13, 14. You sell it January 1, 2015. Or let's say you sell it, you sell it January 1, 2015. Exactly 5 years after you bought it. But during that period, you got a job in a different city on January 1, 2013, you move to that city to take that job, and you rent the property out during that last couple of years. Question is, do you meet, well, you still meet the ownership test, right, because you still own the property. You still meet the use test, right, because you used it as your primary or principal residence for 2 years of the 5 years ending on the date of sale. Okay, so, this gives you some flexibility to move if you have to, for whatever reason, rent the property out until you can sell it, or maybe you don't even rent it out. Maybe you just have it on the market and you're stuck with 2 house payments. That happens. So this gives you that flexibility. All right, so example. When Tyler and Jasmine were married, Jasmine moved into Tyler's home located in Denver, Colorado. Tyler had purchased the home 2 years before the marriage, and after the marriage, the couple lived in the home together as their principal residence for 3 years before selling the home to move to Chicago. Tyler was the sole owner of the home for the entire 5 years he resided in the home. So we have at least one of the taxpayers meeting the ownership test. And because they lived in the home, both of them, 3 years, they meet the 2-year use test. And so, assuming they file married filing jointly, which is what this is about, would gain on the sale of the home qualify for the $500,000 exclusion available to married couples filing jointly, even though Jasmine was never an owner of the home? Yes, because only one of the taxpayers has to meet the ownership test, but both have to meet the use test in order to qualify for the full exclusion. Now, understand that this exclusion is the maximum amount you can exclude. Now, let's say this couple he bought the home, what, 5 years ago? Let's say he bought it for $300,000. And if you know anything about some of the housing markets, especially Denver, it's just outrageous how property values have gone up. So, I mean, this rule helps elderly people who have these big homes that they had maybe for, I don't know, 20, 30, 40, 50 years. And now it's time to downsize. It also helps people in these areas where the value of homes has skyrocketed. But I mean, this is unusual circumstances. I suppose people in Portland might have this problem either now or sometime in the future as more Californians continue to flock there, which is sad. But, it's going to price people out of the market. And it affects rental prices as well, and I think that's happening in Portland right now as we speak. So anyway, the answer to this question, though, is they get the $500,000 exclusion. My point is that's the maximum amount, but if let's say he bought the home for $300,000 and they sell it for $400,000. They're eligible for a $500,000 exclusion because they meet the ownership test and use test, but their gain's only $100,000. So, this is the cap. Now, having said that, if if they live there 20, 30 years, let's say this guy bought the home way back when, in the 80s, and lived there 30 years, and he bought it for $100,000 and it's now worth $500,000, or let's say $700,000. So he's got a $600,000 gain. And of course, he and his wife are the owners. In that case, they're going to have an exclusion, married filing jointly, of $500,000, and the excess gain of $100,000 is taxed as a long-term capital gain. Well, what happens if you don't meet this ownership and use test? What if you buy a home, and I mainly want to focus on this hardship circumstances. You buy a home in Portland, and a year into the ownership and use test, you are, let's say you're laid off and you have to get another job, but unfortunately that job is in Chicago. And so you sell your home at some point within the 5-year period. And so this hardship circumstances at least allows you to recoup part of your exclusion. or exclude part of the gain, I guess I should say, even though you don't meet the ownership and use test, but you did partially and would have, I guess, but for this hardship. Now, they don't get into deep detail as to what qualifies as a hardship, but it says that could be due to a change of employment, significant health issues, or other unforeseen financial difficulties. So, kind of broad and vague. Now, if it is for employment purposes, you have to change jobs. You have to meet the 50-mile rule we talked about when we were discussing the deductibility of moving expenses. So look over that. It just says that if you're moving because of employment circumstances, the taxpayer's new place of employment must be at least 50 miles farther from the residence that is sold than was the previous place of employment. And so, said another way, the taxpayer will not qualify unless the taxpayer's commute from the old home to the new job is at least 50 miles longer than the taxpayer's commute from the old job, from the old home to the old job. So, Portland to Chicago, that's a no-brainer. Portland to Vancouver could be a problem. Probably is a problem. And so, assuming that your circumstances is a hardship, how do you calculate the amount of exclusion? Well, you simply take the exclusion. If you're MFJ, it's $500,000. If you're not, then it's $250,000. Times the months that the taxpayer meets the ownership use requirements, and you divide those months into 24 months, the 2-year requirement for both. So if you met the requirements for a year, you would get exactly, and let's say you're married filing jointly, you would get of the $500,000 exclusion, you would get an exclusion cap of $250,000 in that case. Exactly half, because you met one half of the ownership use test, 12 of 24 months. Now again, are you going to buy a home and a year later sell it for a gain of $250,000? Not likely. I mean, my experience is if you sell a home, if you buy a home and sell it within the first 10 years, unless you've got a situation where market prices are just skyrocketing in that area, more than likely what you're going to have is a wash. In other words, you're going to sell it for what you bought it for, And in many cases, if the sale is pretty close to after its purchase, you're going to lose money on the deal. So I think mainly this is for elderly people who want to scale down to a smaller home. And so what they've done is allowed taxpayers to exclude a fairly large amount of that gain. Note here, and we haven't talked about this too much, but note here that gains can these gains can be caused by skyrocketing real estate prices, but over time it could be caused by just inflation. And none of these gains are indexed for inflation. Wouldn't it be great if we had a situation where Congress said, well, we're going to increase your basis every year for the amount of, by the percentage of inflation for the year. And so you could increase your basis, let's say inflation was 2%. And so Congress says, well, we're going to allow you to increase your basis by 2% inflation. Note what would happen there. You would have less gain on the sale of some of these assets. So, some of this, if you've lived in a home for 30 years, the gain may not be due to necessarily skyrocketing market prices, just the effects of inflation. Over time, the cost of things go up. So here's an example of this hardship rule. Assume that when the Jeffersons moved from Denver, they purchased a home in Chicago for $275,000 and moved into the home on July 1 of year 0. In January of year 1, 6 months later, Tyler accepted a work opportunity with a different employer located in Miami, Florida. On February of year 1, the Jeffersons sold their home for $425,000 and permanently relocated to Miami. How much of the $150,000 realized gain on their home sale would the Jeffersons recognize? At what rate would the gain be taxed? So that's a lot of stuff there. So they purchased it for $275,000. Sold for $425,000, so you've got a gain there of what, $150,000? How much of the $150,000 realized gain on their home sale would Jeffersons recognize? At what rate would the gain be taxed? I think that's two questions, but anyway. Well, I think what they have here, they used it for 6 months, right? Excuse me, 7 months. So you would take the full exclusion. Here you've got MFJ, so it's $500,000, and then you multiply that times the 7 months that are qualifying, divided into 24, and what you come up with is 145,833. Well, they sold it for more than that, so the difference is going to be a capital gain. They get to exclude 145,833 of the gain, and the excess is capital gain. So 4,167 is taxed as a capital gain, but because they held the property for less than 1 year, unfortunately, it's short-term capital gain, which, as you should know by now, is subject to ordinary tax rates. Whatever the taxpayer's ordinary tax rate is what's going to be the rate. All right, we've already gone through most of this stuff, so I'm just going to kind of skip over it. And I just want to make one point. Certainly rental property, you have to include the rental income, but you get to deduct expenses, including depreciation on the home. So, I mean, we really don't have time to go into that. So, it's really not going to be something that you're going to be tested over. All right, so the next thing I want to talk about is business use of the home. Okay, and this is our last bit that we'll talk about. The Congress has allowed a limited home office use deduction. So any expense related to your home office may be deductible, but only if you meet certain requirements. And so, first, the taxpayer must use the home or part of the home exclusively and regularly as either their principal place of business for any of the taxpayer's trade or business, or a place to meet with patients, clients in the normal course of business. So one or the other. And so you have to use the home or part of the home exclusively and regularly as either the principal place of business or a place to meet with patients or clients in the normal course of business. Well, what is this meant for, mainly? Well, this whole legislation came out of a case called the Solomon case. Dr. Solomon was an emergency room physician. And you may not know this, but emergency room physicians are not employees of the hospital. They are sole proprietors. They are self-employed, independent contractors, if you will. And so, certainly when he was at the hospital, he met with patients, did all those things you would expect of an ER doctor to do, but, this guy's in business for himself, and what he has to do in his administrative duties, he has to, bill patients and do other book work that a normal medical type business would have to do. And so he had a home office, and tried to deduct that home office as a deductible expense. And the IRS disallowed it. And this case went all the way up to the Supreme Court, and they denied Dr. Solomon's home office expenses, although they did so they were pretty sympathetic with Dr. Solomon, and basically what they said is that, this problem needs to be fixed, but it's not our problem to fix. It's up to Congress to fix this problem. And so, this was back in the early 90s, I believe, mid 90s maybe. No, it had to be early 90s, late 80s, early 90s. And so, can't remember how long this went on, but sometime after Solomon case went to the Supreme Court, Congress decided to fix this problem, and so it's pretty limited. In the case of Dr. Solomon, if this case were happening now, certainly if he had a home office that he used exclusively and regularly to bill clients, that's certainly going to be meeting the one requirement, the principal place of business for any of the taxpayers' trade or business, right? Because while he's not treating clients or patients there, he's certainly using this part of the home exclusively and regularly to do his administrative work, which is part of any of the taxpayer's trade or business, right? Certainly, I've seen this. Chiropractor might have a place in their home off to the side where they meet with clients and, do their adjustments and all that junk. So, in that case, if it's, as long as it's used exclusively and regularly, that would be a place to meet with clients or patients in that normal course of business. So that would certainly meet that requirement for the chiropractor. If you're just using, let's say, part of the home to store products, probably not going to work. If you're going to use the home just because it's convenient, let's say you have a home office, but you also have a real office, you're just using the home office because it's convenient. Sometimes you just want to you don't want to go into the office, you just want to do your work at home, so you have this home office. That's not going to work either. And so this is mainly meant for sole proprietors and those types. If you're self-employed, it's deductive for AGI, but the deduction's limited to business income before the deduction. And there's a couple of different types of methods you can use. And note here that you have to, let's say like depreciation expense or, the home mortgage expense, the heating expense, et cetera, insurance expense. Some of this stuff on the home is going to have to be allocated between the part of the home that's used for your business use versus part of the home that's not used for business purposes. Okay, so, and there's a couple of methods for this, but let's say just, for the sake of ease and understanding, let's say that you use 20% of the square footage of the house exclusively for business use. Okay, you meet all the requirements. So 20% is used for business use. And you have these expenses. Let's just take one expense. Insurance expense. Insurance on the house for the whole year is $1,200. How are you going to allocate between personal use and business use? Well, usually you're going to do it on a percentage basis. You could do a square foot basis, but it's still going to come down to a percentage. And so, let's say $1,200 is your yearly insurance expense, and you use 20% of the home for business use. What your deductible expense is going to be is 20% of that $1,200. So just to give you an example of how that would work, you'd have to do that with the various expenses. Okay, so I didn't want to get too deep into that, but I did want to talk about it because it does come up. All right, that's it.